This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and here we are again for our open house Q&A, which is, for the new folks, this is something I do every month, and it's our time to get together and look at stocks and talk about the market. And I do this the Monday that follows every expiration Friday. And if you're not an option trader, then let me tell you when options expiration Friday is. That is the third Friday of every month. So I can't say that it's going to be the third Monday of every month or the fourth Monday, because it might not work out that way. But it's always the Monday that follows the third Friday. Excuse me. My voice is a little sore after the weekend. The national championship lacrosse tournament was on Saturday, and it's just one of those games. I have a tendency to yell at the television. I'm a lacrosse coach. I can't help it. And a lot of the guys that are playing at the World Cup level are guys I coached, and I don't know if we have any lacrosse fans on here, but the World Games played and the U.S. won, and two of my guys, Jesse and Jake Bernhardt, were on the winning team, and this is the second time they have a gold medal now, so it's pretty amazing. So let me tell you what's going on my chart here, because if you haven't been receiving my trade alerts, the bottom of the chart is set up with the stochastics oscillator. And I'm going to be talking about this in length today. And when we look at your stocks and we analyze your stocks in an attempt to forecast the price action, I'm going to show you how to properly read the stochastics. And hopefully you'll use that as a tool. I hope you don't use it as a crutch. I again will repeat, this is a tool that's used to complement the price action. And so the way we've been reading price all along is the way we continue to read price. And we'll continue to do that for as long as I can breathe. But what you do is you look at the candles and then you start reading the stochastics to see if you're getting any unusual signals or confirmation signals. And that's how we're going to do it. So as I start off each session, I go over the markets in general to show you what we're looking at. And this is the Dow Jones Industrial Average ETF, ticker symbol DIA. It's the diamonds. And last Friday, if you got my weekly market report, I drew these lines. And I said that early in the week, we're most likely going to rally and then start to pull back, possibly to fill this gap that was left on Thursday in the diamonds. Okay, this was news that came out that the U.S. was going to be sitting down with China to talk trade, and the markets, I think they overreacted to that, but it reacted, and we had a gap up on the diamonds on pretty strong volume. Now, one of the reasons that I thought that we would go up is because we did have this long candle here on Friday. But notice what's happened today. We have a not so long candle. That's very close to a spinning top. It's a small-bodied candle. And if you notice at the bottom, today's volume was lower than what we had on Friday. So with that volume dropping off as the stock goes higher, that's telling us that the buyers are losing their momentum. Now let's throw the stochastics in there, and I'm going to tell you a quick story before we get going. In 1954, there was a fellow by the name Mr. Distant, and he created a company called investor education. And he actually developed and wrote the formula for the stochastics oscillator. And if you know anything about technical analysis, you'll know that there's many different indicators that are out there now. There's the MACD, there's the Williams percent R, there is the relative strength index, and Larry Williams actually borrowed the percent R from the company in Chicago. They had the percent K, the percent R, the percent A, and it turned out that the percent K was the best formula for what they were looking for. But in the percent R, Larry decided to take that formula and create another oscillator. And that's what happened back then. Now, keep in mind, this was in 1954. This is long before computers hit the scene. And right around the late to mid 60s, there was a fellow by the name of George Lane who came onto this company, and they hired him to talk commodities and teach commodities to the traders that were going to their school. So although George Lane did not write the formula for stochastics, he actually gets most of the credit for developing it into the marketplace. He wrote a series of articles, and he promoted it, and he talked about it, and he used it, and he went on speaking engagements, and he was more or less the cheerleader that got it out there to where it was being used by a good number of traders. Now, if you look down at the bottom, there's two parallel lines that run horizontally. If you look all the way to the right, the bottom line stops right there on that scale at 20. The upper line is up here at 80. And so George Lane would always talk about a toy rocket. He said, if you launched a rocket out in a field and you watch that rocket, the first thing that changes before it starts heading back to the ground is the momentum. The momentum will start to change. So the percent K, which is this blue line, that's measuring the momentum of the stock. Okay, so think of that as a momentum indicator. Now, I'm just going to talk about the blue line here for a second, okay? When the blue line drops below 20%, let me squish these lenses down a little bit so you can see it. If you look to the left, you'll see that back here, the blue line, the K line, was down below 20%. That is considered to be oversold. Over 80 is considered to be overbought. Now, the red line is nothing more than a 3-period moving average of the blue line. That's all it is. And if you've been listening to me long enough, you'll know that I talk about the moving average crossover method, and I use that quite a bit. I talk about volume and how if volume is going up with the price of the stock, that's a sign that the buyers are motivated. If the stock drops, the volume drops like we see today, and the stock is still going up, you can also look at that as the rocket is going up, but now the volume, you can think of that as the fuel. The fuel is starting to run out of the rocket. But again, that blue line is going to measure the momentum change. So right now, the Dow is in, as defined, it is in an overbought condition. Now, please understand, just because a stock is overbought doesn't mean you have to sell it right then and there. In fact, a stock could stay overbought for a very long period of time. If it's in a significant upward trend and that momentum is still going, this blue line could be pinned all the way at the top. And so you have to wait for it to shift and start to pivot down. And the sell signal comes when the K line, the blue line here, crosses down below the red line. And that's when the sell signal takes place. Okay, so again, make sure you understand how that works. We'll be looking at this as a tool, not as a crutch, remember, as we look at your stocks as well. Now, playing this out for the rest of the week, I still think that we can go lower and possibly even fill this gap down here. So be careful if you have any long positions. You might want to protect those with stops. If you're an option trader and you're looking for ideas to maybe sell a call spread or take a long put position, wait for those lines to cross and wait for the price to start to go down. Okay, so that's the diamonds. Now, look at the Qs. The NASDAQ market, I said, would rally early in the week. And I think that the NASDAQ is actually a little bit stronger than the diamonds because the NASDAQ doesn't have, excuse me, NASDAQ doesn't have any significant gaps down below the market to pull it down. So I think the NASDAQ will start to move up. And I think a big part of that could actually be Tesla. Tesla took a big hit today and then rebounded. I'll maybe look at that stock later. But there's a lot of news coming out on Tesla. That is a NASDAQ stock. It could cause a chain reaction for NASDAQ stocks to rally. But I'm not quite convinced that the NASDAQ is going to break over that resistance up here. So again, that's what I said last week in the weekly market report, and I still stand on that forecast. Now, looking at the spiders, that's the S&P 500, said we would go up and then pull back. Today, Monday, we're going up a little bit. The spiders starting to get overbought, not in a big way, but it's at 81.53 today, so it's over 80. It's overbought, and the NASDAQ, the spiders has a gap below the market as well. So I think that could pull back later in the week. Okay, let's look at the Russell 2000, which is a more broad-based index. Same thing. I said that it would go up, and this was my resistance point back here. I didn't draw a horizontal line, and I'm not going to mark up the chart here. But if you look, oh, there it is. I did draw the horizontal line. All right. So I said this is a resistance point, and it will most likely rally up to resistance and start to pull back. See how nice this works? Now, again, the stochastics is starting to show overbought for the Russell 2000. And, it's going to be interesting because I want, if you could, keep an eye on the stochastics. If you have it set up on your chart, I use the slow stochastic. The slow stochastic is a smoother line. It's not as sensitive or erratic as the fast stochastic. So I use the slow stochastic, and the D line, the red line there, is just the moving average of the slow stochastic. All right. I wrote an article for, who did I write it for? I wrote it for The Money Show, and it explains a little bit more about the stochastics. If you have a chance to Google that, just Google moneyshow.com and put my name in there. And I think, oh shoot, I've been writing so many articles. It's called The Tools of the Trade. Tools of the Trade is the name of the article, so you might want to read that. It's very, very short read. It should only take you maybe 4 minutes, 5 minutes, that's it. And you'll be done, but you'll get a good idea of stochastics. All right, so that's a Russell 2000. Now look at the VIX. I want to show you something. I said that the VIX would most likely drop, and that's what's happening today as well. There's a gap below the market. Now, the funny thing about the VIX is that it just about 100% of the gaps on the VIX fill. There's a gap here. So there's a very good chance that this gap will fill. If it doesn't fill this week, then it could fill next week. But there's almost 100% chance that's going to fill. Why is that 100% and not 80% like a lot of other stocks? Well, because the VIX is not a stock. It's an indicator or an index that measures volatility. It more or less oscillates. So the stochastics actually is an oscillator on an oscillating index. You see, so this is interesting. And you could see that today the K line crossed the D line and that is a sell signal. So chances are this K line is going to drop a little bit more, and so will the VIX. And keep an eye on that. If you're watching this, just keep it on your charts and follow along. And I think you're gonna have a good time with that. Okay, did I leave anything out? Let me see. I got the spiders, the diamonds, the Russell 2000, the Qs, and the VIX. Okay, got that. All right, now as we do each and every month, I open up the floor to questions, and I open them up to stocks. And so Ron said, okay, that was a sound check. All right. So let's see. Ron has ABR looking for an entry point. Now, Phil, I'll get to your Verizon here in a minute. and Sean, I'll get to yours as well. Please, if you're going to submit, if you're brand new to this open house and you like me to analyze the stock, at least tell me what your idea is. Are you thinking about buying it? Do you already own it? Maybe you're thinking for an exit point or a stop point. You know, maybe you don't have a position, but you're just curious, whatever. Put your intention on there, and I'll be able to help you. Like Ron said, ABR, would this be a good entry point? Looks like it's in an uptrend. Okay, so let me put ABR in there. Yeah, let me see, ABR. There we go. ABR. Oh, absolutely. It is in an uptrend. And you got to watch this one, Ron, because this one is, yeah, it's in an uptrend, but look what's happening. And you got to be really careful if you think about an entry point, because there's one, two, well, it's not quite a green candle, but you got a stretch of green here at a resistance point, and the volume is dropping. Let me see if I could zoom in so you can see that volume. All right, see the volume that doesn't look like there's a whole lot of volume increase there, but there is a double top already, and this could, if it starts pulling back here, Ron, that actually could be a head and shoulders pattern forming. Because let me tell you that when the peak, see this resistance on the left shoulder, if we're going to look at it as a head and shoulders, here's the left shoulder, here's the head. If it pulls back, this will be the right shoulder. And you'll notice that the volume is dropping in sequence here. So normally you see a higher volume at the head and then a lower volume at the right shoulder if it's head and shoulders that's getting ready to break. I don't like that one only because it's already looks like it's overextended. And if you look at the weekly chart, it's gone vertical. And by the way, the stochastics works on the weekly chart as well. And it looks like this week, see how the blue line is just touching the red line? It hasn't crossed yet, but it's right on top of it. This could actually be a sell signal developing here on the weekly chart. So be careful of that, Ron, because this is one of those stocks that it wasn't too long ago, back in April here. You see it was trading around 8.5. Now it's up around 11.5. This thing could easily pull back 50% and wind up back at 10. 50% of the move is what I'm talking about, not 50% of the price. But you could have a 50% pullback of this upper leg, and it's right around $10. So at $10, I would definitely be a buyer if you see any pivot points there. So just be really careful that if you do decide to buy for whatever reason, then please make sure you put a stop in there. Okay, let's go right to Phil. And Phil, I'm already on the weekly chart, so I might as well start there. You could see that there is a pretty significant resistance area right here. You see this? And so we have a resistance that was back in January of 2017. You have a high here in January 2018 that pulled back from. And now it looks like it's bumping its head against resistance again, with the first candle of the week here, or the first day of the week, is giving us a red candle. The stochastics is already overbought at 91, almost 92%. So be really careful on that one, all right, Phil, because if you don't have a position, but I would wait for this one to pull back before you get in. And I see that your notes there say you want to purchase Verizon at 50, thinking of, what does it say, writing cash covered puts on VZ. Well, I would wait for the pullback on that one because this one could very well pull back 50% of this move. Again, this is a weekly chart, and the stochastics is overboard. Let's look at the daily chart and see what other kind of signs we have, see if it confirms what we're talking about. Okay, it does. Now, if the stochastics wasn't down here, you notice up top, we see they call this a stale green light, 4 green candles in a row, and the volume was increasing on all of those green candles. Today's volume is about 40% less than what it was on Friday, and we have a red candle. That's number one. Number two, there's a wide divergence here from that moving average. It's called the rubber band effect. That could easily snap back, and you look that this stock does not like staying that far above that moving average. You see how it goes above and then it snaps back. Well, this stretch that we're seeing here is very close to what we saw that stretch back here in April. So I think this one actually could start pulling back. And notice how this stochastics, the K line, is telling us the rocket is losing momentum. So it's now shifting the momentum to the downside. The high here was 91, almost 92 on the high. And you notice that whenever this one gets up there, 92, 93, it tends to pull back. I'm not saying it's going to go into a long-lasting downward trend. I'm just saying there's a good chance that it could pull back to the moving average. From the looks of the moving average, I don't know if you'll get it at 50, but if you see any kind of a bounce down here off of that 20-period moving average, let's say you see a bullish engulfing pattern, a hammer pattern, or something bullish, a harami, maybe a doji, something like that. That could be your sign. Okay, so thanks for that. And now let's move on. Now, I see the stock symbols are stacking up. We have 1, 2, 3, 4. Yeah, I think we have room for a couple more stock symbols if anyone wants to put them in there. I'll be able to get through all these for sure. All right, now Sean is looking at SLV. Now, I must first say I have a pretty concentrated position in SLV. And last Wednesday, it was Thursday, I bought more. And the reason I bought more, I'll show you why I bought more. Silver gap down here. And then the very next day, you see this small little body candle? There's a gap above the market, and it's a significant drop in the volume. So I got long on this day. Now, the new position that I took last week is not part of my long-term plan. This position I took last week is just going to be a trade. I'm looking for the gap to fill, and then I'm going to get out of that. Not all my shares, but just the ones I bought last week, because I'm just looking to make a quick profit on the gap fill. All right. So, Sean, I like silver. It showed the buy signal on Friday right here. Stochastics started pulling. Stochastics, this was another reason why I bought it. Stochastics was way down here below 8. Now, remember, below 20 is oversold. Below 8 is ridiculous, right? That's like, got to buy it, especially when you got a small candle. So, Friday, it crossed. Right, so you got a buy signal, and I would not be surprised if the stochastic starts running up like that on silver. So I think it's still a good buy at this level. You're down below production costs, and what that means is you're actually still able to buy it right now, cheaper than the miners are pulling it out of the ground. I just have to buy it. I've been trading silver since 1982. Whenever it gets below production costs, I buy it. And there hasn't been a time that I've lost money buying it below production costs. Now, I have lost money in silver when I got greedy and it was trading 11 and a half and it went to 7 and a half because I wasn't following the charts. I thought I was, a guru and I was getting cocky on Wall Street. I took a big hit in silver in 1987 because I thought it was going to keep going, but then we had the crash in the market, so that affected silver. But anytime it gets below production costs, I'm a buyer. And whether you want to hold it long term, it's up to you, but I think there's still a trade in there. All right. Hey, David, welcome. And David has Intel, INTC, for a possible put sale. Now, Intel is a NASDAQ stock, and if you're not an option trader, selling a put basically obligates you to buy the stock. And what happens is when you sell a put, people pay you money to buy the stock. Now, while I like your idea, David, look at what's happening. We have a red candle today, and the stochastics is still going lower. I think that's crazy low. It's down to 10.78. It could go a little bit lower, but what I would do is I would wait for a significant bullish candle, because as soon as you see a bullish candle, whether it be a bullish engulfing pattern, a doji, a spinning top, you'll see that the stochastics will start moving up. So you could actually, not to really get crazy here, but you could forecast the stochastics oscillator by looking at the candle itself. So I think you're very, very close to a buy here. So again, David, if you sell a put, I would probably, I wouldn't be afraid to sell like anything that has a premium at this point. I mean, I don't know what kind of premium you're going to get on the 45s. Let's take a look. I'm just going to look at the option trade here for a second, see if the 45s have any premium. They don't have a whole lot of premium. I wouldn't be afraid to sell the 46s, close to $1, because if it's trading 46 and a half and it looks bullish tomorrow, right, then you're obligating yourself to buy it below the market and they'll pay almost $1. So your cost base is going to be around 45 and a half, close to it. So I think that is a good trade. You get the wide divergence here from the moving average. Intel does not like that. And so I think it could get right back up here. There's also a gap up here. That would be a good target price. So David, if you sell a put and it moves up to fill the gap, I know there's another gap up here, but you want to watch to see if you have any kind of a pullback at this point, because then you could cover your put and take your profit. All right. All right. So hopefully that helped you. All right. Now, Bob is looking at CARG, and Bob is waiting for a gap created by earnings to fill. All right. Let's see. Now, this is an interesting one because, Bob, I like your idea, but this gap is still open, and it looks like the stock is trying to do like a little head fake. Here's what I think could happen. You notice the volume picked up a little bit today, so that tells us that the buyers are coming in, but they didn't do it with a convincing green candle. I think it's going to do this. That's what I think it's going to do. So I would say wait with patience. So if you're going to go long calls, I would wait on that one, because it could come back to fill the gap after you bought the calls if you buy them too early. And this one, I think I'm going to take a guess that the weekly chart is going to show pretty overbought. Let's see. Yes, I go with the weekly chart. See, the weekly chart is showing a cross on the stochastics. So that one, I would abandon that idea of buying a call on this one. I would wait on another one. I recently got long on Ford. I'm just telling you. See, Ford was look at Ford. The stochastics over here was down below 5. It was 4.19. Look at that. So I'm looking at stocks like this. Even though Ford is in a downward trading channel, this one could easily pop up. And I'm just looking to do a trade. Buy it below 10, sell it at 10.5 or 11, and I'm out. Yeah. So, and that's a cheap stock. I just kind of threw that out there to let you know what I'm trading. But yeah, the CARG, you got to watch that one. All right. Now, Stuart is looking to buy NUGT. And while I'm on the weekly chart, let's take a look at that. Well, the weekly chart is showing us that the stochastics is at, remember, this is a 3-year low right here. This is, the stochastics is a 3-year chart that I have it set on. And you notice, actually, there was one other time that it was lower than it was here. And the stochastic was down at 3, what was it down to? Stochastics was down to 5.1 here. All right, so it actually it's down to 5. So this is a 3-year low on the stochastics. And this, although this is a leveraged ETF, this is 3 times the underlying in the gold index. You got to be really careful with this one. This should not be a long-term buy, hold, tuck it away, forever trade. This is a trading vehicle. It's a trading instrument. So far, the weekly chart is a screaming buy. Let's see what the daily chart says. And the daily chart is a screaming buy. See the cross today. Today you got the buy signal. So I wouldn't wait on that one, Stuart, because there's a gap above the market here. And, it's trading around 13.9. And this one, just the gap fill, I mean, that would give you a really nice return around 16.5. You're getting 2.5 points on just that gap fill. Plus, look at how wide that divergence is from that moving average. And you got a drop in volume telling us the sellers are slowing. It seems like everything I'm looking at is telling me buy it. So I would buy it if I were you, and then I would put my stop right below this low right here. Put the low below 12.5. Give yourself about $1.50 stop loss, a risk per share on that one. Okay, Amalia. All right. JNUG, looking for an entry point. Let's see. JNUG. And this is, okay, this is another one. It's in the same, JNUG, it's in the same industry. So this one too, it's a little bit cheaper. This one's giving a buy. You got a gap above the market, which would be a get out point. I wouldn't even get greedy and wait for it to get to the 20 period moving average. I would just wait for that gap to fill right there, and then get out, take your profit, and run. That's the way that one looks, just like that. Boom. It might take a week or so to get back up there, but I think it would be worth it. Okay, I'm looking at the clock. We still have a lot of time. All right, Facebook. Interesting. Ann has Facebook, and you're holding it. All right. Now, Facebook is under a lot of pressure, obviously, but so is Twitter. Now, let me explain. There's a lot more to this than just the chart. I put a post out, I think it was on Twitter, that Twitter and Facebook have dropped dramatically because of the political firestorm they've chosen to get into. Whether you side with Facebook or not for censoring or deleting posts or whatever it is, people don't like this. Investors don't like when a company takes a political stance. They do not like it. I don't know what they're teaching in business school these days, but I've always learned, unless you're in my business where, it doesn't matter if you have a political stance or not. But when you're a social media company or you're a football team or whatever it may be, you have to understand that you're alienating 50% of your audience, 50% when you take a political stance. The reason it doesn't bother me is because I'm just going to blurt it right out there. I'm a conservative, and most of investors that I deal with, the large majority are conservative Republicans. And so I'm not going to really offend anyone in my audience. I don't use profanity or anything like that on the social media, and I'm not looking to insult anyone. But when a company like Facebook takes a political stance, it's going to hurt them. Now, I don't know if this gap is going to fill. I don't know if it might take a year. It might take 2 years. I don't know. But Ann, let me ask you, where did you get in on this one? Please tell me you didn't get in over 200. But let me see. I know there's a delay. If you could, tell me when you got in, and then I'll give you some good news. All right, so you got in at 112. What? You got in at 112. Oh, good for you. All right, well, here's the good news. There's a gap below the market that looks like it's trying to fill. All right, so the gap fill is not going to be anywhere near your entry point at 112. It's going to be around 160. I know you certainly don't want it to drop down to 160, but here's the other good news. There's a little bit of a hammer pattern here on today's candle. The volume is dropping, telling us that the sellers are losing momentum. That's a good thing for you. And look at that stochastics. The stochastic is down. Let me see. I got to get the reading here. That's pretty low. You see that is reading at 8.26. So again, the stochastics, if it could talk to you, it's saying it's a screaming buy. So my short-term forecast on Facebook is going to be this resistance point, which could very much help you because it's up around 189. Now, my second question to you, not to put you on the spot here, Ann, but number one, where is your stop? Where's your stop on that one? Are you trailing it up with the price of stock? And number two, as you're typing that answer in, where do you plan on getting out? Do you have an exit strategy in mind? So those are two good questions that I hope you can answer. Again, I know there's a little bit of a delay there, so forgive me for not getting that to you right away. Let's see, Ann is 112. Well, yeah, it's a really big delay. Okay, I'll watch that one, and I'll start looking at the other one. But yeah, hopefully you have a stop. What I would do is I would put my stop below 160 if you don't have one at all. No exit strategy. Okay, well, just keep in mind that if it does get up here and fill that gap, it's probably going to start reversing from that point. Okay, and so I don't see a stop loss answer, so I'm assuming you don't have one. But I would put my stop probably below that low right there. So the stop would be, I would say, right around 155. That would be a good place to stop. And as the stock goes up, you could move your stop up according to these lows that seem to be higher lows along the way. So hopefully that'll help you out there. All right, now, David, okay, you have the 45s, 60 days expiration. Yeah, David, I don't know on those puts. I don't know if it's worth taking that kind of risk for just like 40 or 50 cents. So many other stocks that really play out better than that. And if you're looking to get a higher return on your money, then sell a put spread. Don't sell a put, because if you sell the put at 45, you have to come up with the money to buy the stock at 45. But if you sell the 45, buy the 35, then you only have to come up with $10. It's going to save you a lot of margin money having to do a spread instead of an outright put sale. All right. Sabu said, sold Tesla. Okay, here we go. Let's get into some exciting stuff. All right, you sold to September 310, 340. Let me see. Oh, that's a call spread before earnings. I would close the heck out of that. Here's why. Let me just tell you what I did. I sold before Elon Musk started his tweet campaign. I sold the 415s up here, and I bought the 425s for $1. I sold that one for $1. And then his tweet came out on this day, and I don't know if any of you have been following, but as soon as I saw his tweet, I sent a message to the SEC because I said, if Elon Musk even sold one single share after he put that tweet out, then he's manipulating the stock, and that's insider trading. And guess what happened? The SEC started investigating, and as it turns out, he made a false tweet. He didn't have funding secured. Now, with that said, let me tell you, Sabu, this gap has filled today. You see this? The gap has filled. That's number one. There's an 80% chance it's going to rally. And there's gaps above the market here too. You see? So I would close that for that reason alone. But then look all the way down here. Look at the stochastics. It's showing oversold, and it's starting to go up. It hasn't given the buy signal yet, but as soon as the K line starts going up like this, that stock is going to start rallying. So the 310, if you're short the 310 calls, I would get out of that, because that could, in fact, that thing could go into money tomorrow. That could go into money tomorrow. So I would close it. If you have a profit, close it. Hopefully you do. All right. So Ken is looking at DIS. That's Disney. I don't know. There's news out on Disney today. Ken, I don't know if you got it. Evidently in Disneyland, guests were poisoned in the pool. Did you see that? Came out early this afternoon rather. So you're looking at a possible entry point. I would be really careful, because I think Disney is going to get slammed tomorrow on that news. Check the news out. Yes, I don't know. I didn't read the whole story. I just saw the headline that people were being poisoned in the pool. I don't know if it was a chemical or what, but let me tell you, that stock, it closed with a bearish engulfing pattern here, or close to it, and the volume was up. And so my forecast for Disney is going to be this. It's going to probably drop to 108. So I don't, why do I say 108? Because it's right around this area right here, where it'd be like a roll reversal support. So right around between 106 and 108 right here. That's my target. All right, so be really, really careful. I would abandon that idea until all the news gets shaken out, because that one could wind up stinging you if you got long it. So hold off on that. I'm glad you didn't do it today. All right, let's see. We still have some time. Let me see. What's A? David typed in an A. Oh, it might be a typo. A 45 strike in October. Okay, so who wants to put in some more stock symbols? We got a couple more. Let's see. That is my conclusion. Okay, good. I'm glad you're going to get out of the Tesla. All right, let's see. Any more stock symbols? Stock symbols. MU. Kevin, thank you so much. All right, MU. Keep typing in those stock symbols. I still have 17 minutes. I don't want to talk about lacrosse for 17 minutes. I'll bore you. No. So, okay. Oh, buy this. Bam. Now, you didn't tell me what you want to do with this one, Kevin, but that looks like a screaming buy. Here's why. I'll rattle off all the signals because I can see it. Number one, this gap has filled. See? The gap is filled, so there's an 80% chance the stock is going to rally from here. Number one. Number two, there's a wide divergence from that moving average. So the rubber band is stretched. See that? Last time it was stretched that far, it rallied beautifully. All right. Number three, there's another support level down here that it bounced off of. Right. What am I up to? Four. Stochastics was oversold, started turning up. It's getting ready to buy. Now, let me tell you what's happening here. This is why I tell all of you all the time, talk about what we do here. Talk about the charts. Tell people about the weekly market report. Talk about this open house. Why? Because I'm going to focus on the stochastics. If the stochastics, which has been around since 1950s, if the stochastics shows a buy signal, guess how many people are going to buy it on the buy signal? Answer is a lot. Yes, a lot of people are going to buy it because it's giving a buy signal. That's why I tell people to tell everyone about what we do. This has nothing to do with manipulating the market. It is all about gathering the group together so that we react simultaneously on the signals and make money. We're making money on the price swings. Okay? So everything about this one looks like a buy. Everything. And so, Kevin, I don't know. Let me see. Did you type in what your idea is? If you're long it already or you're thinking about buying it, I don't know. But I would definitely buy that one, and I would put my stop somewhere below 45.30. Now I know that's a $3, almost a $3 risk per share, but you definitely want to put a stop on here. In case it drops down below that support, because the next support's down here at 40. Okay. All right. So let's see. Sean is looking at AMD, Advanced Micro. Let's see. AMD. Boom. Doesn't look like a buy signal. Either for short or long. All right. This is not giving me either or. It's not giving me a buy signal. It's not giving me a short sale. So the only thing I could tell you is that it is overextended, but it's not overbought. What does that mean, right? Well, overbought by definition of stochastics would be over 80. It's not over 80. However, I could tell you by looking at the weekly chart, it's going to be overextended. You see? So you got this long leg right here, the pretty long leg, and the volume was increasing last week, but we'll have to see whether or not that volume maintains it this week. Stochastics is actually it's starting to cross back up again, so you got to be careful. But on the weekly chart, I don't see any reason why this one can't get right back to around 1570 right here. It could do just like that on the weekly chart. Let me see what the daily says again. Let's see. Yeah, that would be a good role reversal support level right there. Okay, I have to move my control panel here. All right, Ron is looking at Pfizer, PFE, and let me see, the rest of the question is, in at 33, boom, I would sell it. All right, in at 33, what's a good stop now? All right. All kidding aside, Ron, when I'm looking at a chart, because I've done it so long, I could literally tell you whether I would buy or sell within seconds. Okay, and what I'm seeing here is an inverted hammer, and what that means is a long shadow above the candle is just like what we saw back here, very much like a doji. This thing does not like staying that far above the moving average. The volume is lower today. It's not dramatically lower, but the stochastics is overbought, and it's kind of been overbought. It's kind of crisscrossing up here, but I don't like to stay long stocks like this. And plus, you have a stale green light. I'm going to tell you, I hope everyone watches this one tomorrow. There's a 90% chance it's going to drop tomorrow. And I want everyone to watch that so you can see how accurate charts are. There's a 90% chance that's going to drop tomorrow, which would mean that the stochastics is going to start dropping, possibly give a sell signal there. So I would say I would put my stop right below today's low. Today's low was 42.09. I would give it like 41.91. It sounds crazy, right? I like odd numbers. There's a thing called the power of whole numbers. If you put it in at 41 or put it in at 42, people tend to buy or sell on those numbers. But you put it at 41.91, it'll be below that low, and then you might have another chance to get back in. So talk about that. If you get out and take your profit, I see no reason why you wouldn't want to get back in if it does this. And even if it drops below the 20-period moving average and bounces, that wouldn't be such a bad thing. Okay, so I would get out and then look to buy it right around the $40 level again. All right, let's see. Hendra, welcome. Should I long Cisco, CSCO? Let's take a look. 1, 2, 3. Bam. What do we see? No, don't go long it. Why? It's at resistance. See? I mean, perfectly at resistance right there, right? It's got a gap below the market. The rubber band is stretched above the moving average. It's a wide divergence, and the volume is dropping. So chances are stochastics is going to cross tomorrow and give a sell signal. So do not get long that one. Where would you get long? Well, once the gap fills, which would be around here, and this is why 80% of the time a gap will fill. Now, second part of that rule is 80% of the time after a gap fills, it reverses. So right around this area, should it bounce, would be another good entry point. And I don't know if you're investing in this one or if you're trading it, but this is a really good trading stock. And if you're trading options, this one also has options on it that are pretty good. This one has a very liquid option market right there. So hopefully that'll help you out. If you're not familiar with options, then go visit the Market Guys and look at some of our educational content, and that might help you out. All right, I have time for maybe a couple more. And Richard says PRU, bought it at 96. And this is Prudential, by the way. Bought it at 96, like to sell at $100.55. What do the charts say? All right, well, I think you got a good shot, actually, at selling it at your $100.55 because there's resistance up here. That's right around 101. There's a gap right here. Now, let's measure this gap. I got to zoom in to do this. Let me show everyone how to know when a gap fills. The actual gap is from the low here on August 9th, which is 99.76, to the high here of 98.79. So guess what, Richard? Here's what I would do. There's an 80% chance the gap will fill, and then there's an 80% chance it's going to reverse after it fills. So what does that mean? It means you're going to be so close to getting to your price of $100.55 that you may not get it unless it just trades intraday high and it comes back down. So here's what I would do. As the stock gets up to fill that gap, you would trail your stop to the next low or the previous low in that sequence. So in other words, let's say today is that day, right? So let's say that it's up and filling the gap today. You would put your low just below this low here, because you could see we have a higher low here and a higher high here. We have a higher low here, a higher high here. We have a higher low here, but we don't have a higher high here. That's called the half signal. So I still think it could go higher, but what you want to do is as it gets closer to fill that gap, you want to mark your stop just below the low of that previous day. And that'll at least get you close to your $100.55. Okay. All right. UDN. All right. Entry point for UDN. This is the dollar index. This is bearish, by the way. You're betting that the dollar is going to go down. And actually, it looks pretty good now because you got the stochastics have crossed, but see, UDN, it gaps all the time. So this is a little bit tougher to gauge because it's the dollar, and it gaps. But there's a gap up here that's probably going to fill, and that's going to be close to 21. Yeah, Amelia, I would wait. Here's what I would do. I would wait with patience until it crosses above the 20-period moving average. If you can wait with patience, that's the better place to get in. Why? Because it hasn't been over or hasn't been able to stay over that 20-period moving average in a long time, since back here, since in April. And the dollar has been doing very well lately. And that's why UDN has been going down. They're inversely related, right? So I would wait for that to get over the 20-period moving average and then get in at that point, and then hopefully that'll help you out. All right, Phil is looking at Macy's. Now, Phil, this is, you're looking, it says I want to purchase them at 35. I don't know if that's a good idea. Here's why. It's trading 38 now. So if you are trying to buy it at 35, what has to happen between now and that price for you to get to buy it? Well, what happens is the sellers have to take control of the stock. And you don't know if they're going to stop selling at 35. Now, there's a support level here. That's a pretty significant support level. So you have a gap above the market. Say there's a gap above the market up here. 80% chance it's going to fill. Then 80% chance it's going to drop. So if it drops all the way back down to your $35 price, I would wait for the pivot point before you get in. And it could very well wind up staying in this sideways trading channel for a while. And that would be a good opportunity for you. You see how it's trading in a channel? So if it gets down to the bottom channel line, it's at role reversal support, then again, wait with patience. What I normally do is I put my alerts in place, and that could help you out. All right, now, Herschel, we're going to leave you at the last one, LMT. Is that Lockheed Martin? I think so. Yeah, Lockheed Martin. Okay. In a channel between 314 and 324. Yep, you're absolutely right. It's at the top of the channel right now. And I have a major support level down here. But buy low, sell high, short high, and buy back low. Well, this one is already showing overbought on the stochastics. So if you decide to short it, you're going to have to keep a tight stop probably above that high. And then there's a gap below the market. Now, again, if you sell it at 324 and then try to buy it back when it fills the gap around 318, that's not a bad profit if you can grab $6. However, shorting a stock like that is going to cost you a lot of money in margin. So the better way to do that is to either buy long-term puts or sell call spreads so that you don't have to lay out all that money. Because the broker is going to require you to put up a big chunk in margin requirement, and for $6 it may not be worth the risk. But with options you can. All righty. Well, I have 2 minutes left. I just want to thank everyone once again for following each and every week. We had a good crowd tonight. Please, you're doing us all a favor if you talk about what we do, what I do, what the Market Guys does. Talk about the weekly market report and talk about how to make money to people. And please don't guarantee that they're going to make a profit, but at least expand the horizons, especially the young folks out there. My son started his first day of college in his sophomore year today. And he worked really hard over the summer to save up enough money so he could trade. I'm teaching him how to trade silver because that's something that's like second nature to me. And it's also something that a college student can afford if they work hard during the summer and have a little bit of a brokerage account. So if we're all following the signals precisely together, then we are the ones that are driving the signal to be a better signal. I'm not going to say that we're going to be able to drive silver up to record highs. That's not what we're trying to do. Remember, it's not trying to manipulate the price. We'll leave that up to Elon Musk, right? I just want to make a profit and have everyone else make a profit with the price swings. It's kind of like surfing the price action with your surfboard, which is the computer that we trade with. So have a good rest of the week, folks. It was a pleasure tonight speaking with you. I hope you enjoyed it. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.